Hello and welcome to ESG Trends Behind the Numbers with US SIF, a joint webinar from ClearBridge Investments and the Forum for Sustainable and Responsible Investment, also known as US SIF. I'm Robin Freeman, a portfolio specialist at ClearBridge. Much of my work covers many aspects of ClearBridge's ESG investment program, and so I'm pleased to welcome Meg Voorhees, Director of Research, and Brian McGannon, Director of Policy and Programs at US SIF. US SIF is the U.S. National Nonprofit Membership Association for professionals, firms, and organizations dedicated to advancing the practice and growth of sustainable responsible investing, socially responsible investing, or known as SRI. Forum members support SRI by integrating environmental, social, and governance issues into a portfolio selection analysis, shareholder advocacy, and community investing. ClearBridge is an active member, and our collaboration began over 25 years ago. To start, a brief introduction to our speakers. Meg Voorhees heads the research department at US SIF. She has led the production of US SIF's flagship biennial report on U.S. sustainable and impact investing trends since 2010 and has written or helped develop many of the other resources in US SIF's Education Center. She also chaired the Agenda Committee for US SIF's annual conferences from 2011 through 2019. Before joining the US SIF staff in 2008, Meg directed ESG research for RiskMetrics Group's Financial Research Analysis Division. She's a graduate of Wesleyan University and earned a Master of International Public Policy degree from the School of Advanced International Studies at Johns Hopkins University. Brian McGannon serves as US SIF's lead representative, advancing the interests and perspectives of the sustainable, responsible, and impact investing SRI community with policymakers and stakeholders. Brian comes to US SIF with over 20 years of policy and advocacy experience, most recently as Policy and Engagement Director for the American Sustainable Business Council, where he directed the policy team for a wide range of issues related to sustainability in business and the economy, and served on the executive team. Prior to joining the American Sustainable Business Council in 2011, Brian was instrumental in former Vice President Al Gore's initiative to pass comprehensive climate and energy legislation. Brian received his BA in Political Science from the University of California, San Diego. Meg and Brian were instrumental in producing US SIF's report on U.S. Sustainable and Impact Investing Trends 2020. The report, produced after extensive surveys and research by US SIF, offers both a great overall view of the growth of ESG investing in the U.S., as well as granular views of the roles of different types of money managers and institutional investors, including their strategies and motivations. It also shares key trends in investor advocacy activities such as proxy voting, filing shareholder resolutions, and company engagement, practices that are central to ClearBridge's investment approach. ClearBridge is a sponsor of the report, and we're so excited to have Meg and Brian here today to share some of its highlights and their thoughts on what insight it offers for the investment community going forward. A quick note on our format today. I'll be turning it over to Meg and Brian momentarily so they can walk us through some prepared slides. We will then have a brief question and answer period, and we will be taking questions throughout the presentation via the Q&A window on your screen. We will do our best, on the phone as well. We will do our best to address as many as we can and aim to wrap things up at roughly 1/4 to. With that, I'll turn it over to our guests today. Meg and Brian, thank you so much for joining us today.
Great, Robin, thank you so much. This is Meg Voorhees, and I'm so pleased to be with you this afternoon or this morning, depending on which time zone you are in. And yes, we're happy to present the highlights from our latest biennial report on U.S. sustainable and impact investing trends. And as Robin indicated or hinted, it takes a village to produce this biennial report. There is a lot of research and a lot of moving pieces involved, and we couldn't do it without all of our wonderful sponsors, including ClearBridge has just been a terrific longtime member of US SIF and a frequent sponsor of the Trends Report, and we thank ClearBridge for their support. So let's get right to it. The top line result from the report is that U.S. sustainable investing is continuing its strong growth. When we look over our findings since we first started trying to measure the sustainable investing field in the United States in 1995, you see that chart there going from 1995 to this year, 2020, and you see, the shape of that curve is, I think we'll call it a hockey stick shape, and the crook of that hockey stick is right about 2012. So, from 2005 until roughly 2012, we were seeing sustainable investing represent about 10 to 12% of all professionally managed assets in the United States. It would tend to just grow with the overall pool of managed assets and kind of stay at that same level. And then it really took off after 2012, so it became 18% of professionally managed assets in the U.S. In 2014, 22% in 2016, so roughly 1 out of $5 under professional management were engaged in sustainable investing strategies in 2016, then 26% in 2018, so about 1 in $4, and then this year, 2020, we're finding that sustainable investing assets now account for about 1 in 3 of professionally managed assets in the United States. So, I think when we think about this historical growth and curve, I think some things, what happened, after 2012. I think it's like, a lot of things where you look at, adoption of cell phone use or personal computers or whatever. Things are kind of humming along quietly, and then there's a lot of growth because things have been happening kind of just below the surface. And I think what was happening in the United States and globally is just, a longer time period, more data to understand sustainable investing and financial performance, to see how sustainable investing performs over a number of different business cycles and investment cycles. Obviously, we've grown more aware as investors, as a society, of the existential threat of climate change. We're seeing that driving a lot of sustainable investing strategies. And we're also seeing, as the field has evolved, there are more products, more asset classes are represented, and so depending on what people want in terms of investment products, there's probably something available now in the sustainable investing field. So all of these things, that kind of leads to a virtuous cycle. So let's look at U.S. sustainable investing in 2020. It represented, we identified $17.1 trillion in U.S. domiciled assets in the United States engaged in sustainable investing strategies, and that's up 42% from the $12 trillion we identified in 2018. So what do we mean by sustainable investing? Basically, we're counting, two different things. One is the assets that are managed by money managers who are applying environmental, social, or governance criteria, as Robin mentioned, ESG criteria in investment analysis. So when you look at this stylized bar chart, with one bar here, the blue portion of the bar represents that ESG incorporation by money managers. So we gathered data from 384 investment management firms, 139 of which responded directly to our survey. These money managers could be seeking to exclude or underweight companies where they have ESG concerns, or they could be seeking to include or overweight companies with strong ESG records. So we refer to all these various techniques as ESG incorporation. And then we're also looking at the assets that are engaged in filing shareholder resolutions on ESG issues. This has been part of our definition of sustainable investing for years and years. That's represented by the orange portion of the bar, represented about $2 trillion. The ESG Incorporation, I mentioned earlier, represented about $16.6 trillion. Some assets are involved in both strategies. That's shown by the crosshatched portion of the bar. So we are careful not to double count. So that $17.1 trillion is the net figure of assets engaged in either filing shareholder resolutions or considering ESG criteria in investment analysis. So now I'd like to drill down a little bit and talk about that blue portion of the bar, the ESG incorporation by money managers. And I think I should just quickly back up for a moment. We talk about the blue portion of the bar. The dark blue portion represents money managers who are managing assets on behalf of institutional clients. The light blue portion represents assets managed on behalf of retail or individual clients, and could be high net worth individual clients. We'll come back to that distinction in a moment. So let's look at ESG incorporation by money managers. When we have look at that just since 2005, you can see there's just been phenomenal growth. Once again, really taking off at after 2012, and we see that hockey stick shape there in the curve. So one of the questions we ask money managers on our survey is why they consider ESG factors in investment analysis. So, I mentioned that 139 money managers responded to our survey, and 113 money managers responded to that particular question. They represented a little over a fifth of the $16.6 trillion we identified altogether in ESG incorporation assets by money managers. So this is it's a subset, but it's a pretty robust sample, I would say. The one answer that was cited most often by money managers as to why they considered ESG criteria was to manage risk, and you see it there at the top line in that table. A very close second, which was mentioned by almost as many managers, was client demand. And these managers together represent, the ones who mentioned client demand represented $3.57 trillion. So in asset-weighted terms, client demand was the leading reason or motivation, but a very close second in asset-weighted terms is fiduciary duty. So I think that's also interesting. So if you look at the sixth line down, fiduciary duty is being cited by money managers who represent, well over $3.5 trillion in that sample. We also ask questions about the types of ESG incorporation strategies or techniques that money managers use, and you see the results here of once again, it's a subset of the larger universe of money managers that we identified. 112 money managers responded to this question. But, for many years, negative screening was the predominant strategy. when we looked at the assets affected. And I think that started to change in about 2014 when money managers responding to our trend survey indicated that they were applying ESG integration across slightly more assets than they did for negative screening. And by ESG integration, we are talking about systematic, explicit inclusion of ESG risks and opportunities in the financial analysis. So we're using that fairly specifically, ESG integration, and not to be confused with ESG Incorporation, which we use more generally to refer to other, all sorts of ways that ESG criteria can be considered, including negative screening, or we see further down the list, sustainability themed investing, a number of other techniques there. And now this slide is looking at the types of ESG criteria that money managers say they consider. Increasingly now, money managers will report that they consider ESG generally somehow, or that they do ESG integration, but without specifying these ESG criteria in any further detail. So if you look at that chart, you can see those three very long bars at the top where, managers are saying, we're looking at environmental, social, governance issues generally. End of story. We don't get more detail. But where we do get specific criteria mentioned by money managers, climate change is the top issue for money managers. You can see that represented in the fourth bar from the top, and that's followed by looking into companies' anti-corruption measures. Board issues would be another area, sustainable natural resources in agriculture, and executive pay. So those are the, after those top three bars, looking at general issues, those five specific issues I just mentioned come next. By board issues, we're looking at the diversity, responsiveness, qualifications of board directors. And this is what money managers are looking at. What I think is striking is that sustainable natural resources in agriculture is emerging as a significant ESG criterion. So it's now in the top 5 when we look at specific ESG issues for money managers, and that's up from 10th place in 2018. So who are these money managers, and what are the investment vehicles that they manage and represent? We have this exploding pie chart to explain it all. So you can see that starting at the noon position, we have a large orange wedge, which represents mutual funds, followed by 3 small slivers that represent other registered investment companies, variable annuities, ETFs, closed-end funds, followed by alternative investments that will include the private equity, venture capital funds, hedge funds, other commingled funds, that's the green portion of the wedge, and then we have a dark blue thin wedge, which represents community investing institutions. And then we have this very large portion of the pie here, the kind of French blue, which represents about $11.5 trillion, and we're calling that undisclosed investment vehicles. So what is that? It bothers us too. We don't like this to be such a huge portion of the pie. But basically what's represented there is, first of all, it's about $2 trillion of that is money managers who responded to our survey. We asked money managers to, identify and count the specific investment vehicles where they're considering ESG criteria. So in some cases, money managers just, there's sort of an other miscellaneous category that they can select. They selected that rather than mutual fund, separate account, et cetera. And they may have decided to lump groups of assets together by ESG criteria rather than listing every single product. So as I said, that's about $2 trillion. The second group, which represented about $9.5 trillion, were money managers that did not respond to our survey, but we found information about them through various public disclosures. Often these were the reports they filed with the Principles for Responsible Investment Network. So they released something publicly that indicated they were looking at ESG criteria across all or a broad swath of their assets, but they didn't provide the assets broken down into vehicle type. But in some cases, we did get information about specific ESG criteria that the managers in this blue portion of the pie considered, and the leading issue was climate change, which is considered across $2.7 trillion there. So what I'd like to do is focus a little bit on some of those other, the disclosed investment vehicles and what they look like, how they've changed over time. So let's start with the registered investment company. So if we just go back to that pie chart again, the registered investment companies are represented in that orange portion of the pie, and followed by some small slivers for the three other types of registered investment companies. And we see them in this chart, which is showing the growth over the current and last 4 editions of the Trends report. And we can see that there's been pretty strong growth over time. The dark line represents the number of funds, and the vertical bars represents the assets that they represent. So altogether in 2020, we identified 836 registered investment companies, including 718 mutual funds and 94 ETFs. Together, they represented $3.1 trillion, and their top specific ESG issue is climate change. We have alternative funds. Once again, you can see there's been strong growth since 2012, both in the number of funds and the assets they represent. The largest segment represented in the orange portion of the bar is private equity and venture capital funds, followed by property funds and REITs, that's the gray portion of the bar, and then hedge funds in the blue. Altogether, we found 905 funds representing $716 billion. The leading specific issue for the private equity and venture capital funds is clean technology. For property funds, it's green building and smart growth. And for hedge funds, it's anti-corruption measures. Then we have this category called other commingled funds. These are investment pools that have been commingled for multiple investors but don't fit into the other vehicle categories we cover in this report. It can include privately managed nonprofit trusts, private debt funds, collective investment trusts, and other pooled vehicles that are generally managed for specific types of institutions, such as religious organizations and Taft-Hartley plans. The leading issue that these commingled funds consider is conflict risk, the risk associated with companies doing business in or with repressive regimes. And then we have looked at community investing institutions as a measure, important piece of sustainable investing. It's a small portion in terms of the assets, but it's very vibrant. And we can see that that has been growing steadily over time. Community investing institutions, banks, credit unions, loan funds now represent $266 billion. They specialize in providing financial services to low and moderate income communities in the U.S., and also there are loan funds that operate in similar communities overseas that are based here in the U.S., and we count those as well. And now I'd like to turn to the institutional asset owners who are considering ESG criteria. So if you recall, when we were looking at how the ESG incorporation by money managers, we noted that about $12 trillion of the $16.6 trillion of money manager ESG incorporation was on behalf of institutional clients. So that so we wanted to gather data on or from institutional asset owners directly, just see if we could understand that $12 trillion piece a little bit better. So we were able to gather data on or from 530 institutional asset owners that together represented $6.2 trillion, so a little over half of the $12 trillion that money managers say they manage on behalf of institutional clients. And of these 530 institutions, 132 responded directly to our survey. And for the others, we were able to collect information they had reported or posted publicly. The bulk of these ESG incorporation assets are managed, are held by public funds. That's represented by the orange portion of the vertical bar you see there. These are largely retirement systems, can also be operating funds. They represent $3.4 trillion in ESG incorporation assets. The top specific issue for these public funds is conflict risk. Once again, you know, the risk of doing business with repressive or terrorist regimes. The next most important and asset-weighted terms of these institutional ESG incorporation assets is held by insurance companies. That's the green portion of the bar. They represent $2.2 trillion. And the top specific issue for these insurance companies is climate change. The third largest segment we've identified on the institutional side is educational institutions. It's represented in the gray portion of the bar. In 2020, they represented $378 billion in ESG assets. The top specific ESG issue for educational institutions is climate change. And then foundations are the fourth largest pool of institutional assets we identified. They're represented by that light orange band. In 2020, they accounted for $97 billion in ESG assets, and their top issue is tobacco, and presumably that's a negative stream that's being applied. And when we look at all of these institutions together, the leading ESG criteria, or the top ESG criterion that is looked at is conflict risk. That accounts for $2.73 trillion. And that has been the most prominent ESG criterion for institutions that we have identified since 2010. A close second is climate change. It's now considered across $2.61 trillion in institutional assets, and that increased 17% since 2018. And for the top 5 issues you see here, we're also in the top 5 in 2018 among institutions. Those 4 would be conflict risk, climate change, tobacco, and board issues. But one issue that kind of rose up out of nowhere is sustainable natural resources and agriculture. It was not in the top 10 in 2018. So this has really emerged very rapidly to the fore. And now I know I don't want to use up too much more time. I want to quickly look at investor advocacy. When you think about the chart I showed you several slides back about sustainable investing, that was the orange portion of the sustainable investing assets represented about $2 trillion. And I would say that in 2020, we didn't really see much change in the numbers of money managers and institutions involved in filing or co-filing shareholder resolutions. We identified 149 institutions and 56 money managers, and together they represented nearly $2 trillion in assets, which is about the same as in 2018. When we look at the assets represented in filing resolutions, public funds dominate the space. That's the large orange section of the pie on the left-hand side. When we look at the numbers of institutions or firms involved, faith-based institutions and money managers would be the most significant. They're represented by the dark blue and the green wedges of the pie on the right. But a number of foundations are also active in the space, and they're shown in the light orange wedge of the pie chart on the right. And this chart is looking at the leading ESG issues that were raised in shareholder proposals in terms of the number of proposals filed on those issues from 2018 to 2020. And one thing that's I notice about this chart is that a lot of the issues that we see as prominent in ESG Incorporation also get raised in shareholder proposals. So for instance, climate change is a leading issue. It's the third bar there from the top. But we saw still more proposals filed over the last 3 years on 2 other subjects. One was corporate political activity, looking at companies lobbying, political spending activities, and then also equal employment opportunity and fair labor practices. We've seen a lot of activity around these issues, diversity and inclusion issues in particular. And one thing that strikes me as I look over the recent proxy seasons in shareholder proposals is we're seeing much higher support for environmental and social issues. So there hasn't been a big difference in the numbers of proposals filed. Over the last decade, a number of proposals that come to votes, but we're seeing, a much higher number of shareholder proposals on environmental and social issues getting majority levels of support. So, I counted 26 from 2018 to 20, compared with just 2 from 2012 to 2014. So that's quite striking. We consider corporate political spending and lobbying a governance issue. So I didn't include it in the environmental and social proposals in that first paragraph there. We're also seeing support for these resolutions, which are also typically asking companies to provide more disclosure and greater scrutiny of their corporate political spending and lobbying activity. They've been getting more support. And we also see companies changing their practices over time as a result of shareholder engagement, shareholder proposals. So, one area is we look at this question of independent board chair. Sustainable investors for a long time have been pressing companies to separate the CEO from the chair position, not concentrate all that power in one person, and also that recommending that the chair actually be independent, not a current or former employee of the company. So in 2019, just about a third of S&P 500 companies had independent board chairs, up from 16% a decade earlier. And notably, 2 proposals calling on companies to institute an independent board chair got majority support in 2020. And this has been unusual to get for such proposals to get high levels of support, but it's starting to happen. So sometimes success can invite, opposition, and the SEC has recently instituted a rule to make it a little more difficult for shareholders to file proposals. And I think I'm going to stop talking here and turn things over to Brian McGannon, our Director of Policy and Programs, to talk about some of the policy priorities for US SIF given these developments.
Thanks, Meg. And I will just take a minute to just give a real high-level look at some of the policy issues that tie into the trends that we've been seeing. So as Meg said, the SEC passed a new rule that modifies the rules around shareholder engagement. USF was very active in opposing it in the public comment period. In the new administration, we will continue to work to reverse these rules. The changes largely were based around the ownership thresholds of how much of a company you have to own to be eligible to file a resolution, and then the resubmission threshold. So after you file for the first year, what thresholds do you have to reach? So we'll be looking at those. There's also 2 rules at the Department of Labor that were very significant to the field. One was around inclusion of ESG in ERISA governed plans. Those are largely private sector retirement plans. That rule was recently finalized. It will technically go into effect January 12th. We're hoping to get a pause on that. This would make it much more difficult for retirement plans to consider ESG factors. It does not completely preclude that, but there's enough kind of wobbly language in the rule that would give plan fiduciaries reason to pause and think twice about including ESG in those plans. The second proposal, which is most likely going to be released as a final rule in the next week or so, is around proxy voting within ERISA governed plans. And this is a really difficult, a tough and bad proposal. We don't know what's actually going to be in the final rule, but we know from the proposal that it would really burden investors voting their proxies, constrain them, and the safe harbors would be to basically go along with management. So we are continuing to work to reverse that. And the last one I'll throw out, USF put together a policy recommendations for the next administration. This came out before the election, so we were prepared to advocate for any of this for whichever way the election turned out. But our main priority was to create a White House Office of Sustainable Finance and Business to be the focal point in the administration to advance continued growth in sustainable investment and to accelerate the shift from shareholder-centric company model to a multi-stakeholder model. So I'll stop there, and if there's questions, I'll be around on this policy side. Thanks.
Thank you, Meg and Brian. That was a wonderful presentation, and happy to report we have a number of questions that have come in, so let's get right to it. So one question we've gotten was, I always get asked about the different ESG rating agencies and whether it would be possible to standardize the ratings. The same company can have wildly different ESG ratings just depending on who is rating them. Do you foresee any standardization across the ratings coming anytime soon?
I'm not sure. There seems to be there does seem to be some effort by some of those rating and reporting bodies to work more closely together. So, I know I just saw something recently, with SASB reaching out with the IIRC folks and the Global Reporting Initiative. So we may start seeing some more standardization. So I think maybe I'll just leave it there. But I think it's not going to happen immediately.
Great, thank you. We've gotten a number of questions that are all revolve around diversity, so maybe I'll try to include some of these together. Are you starting to see more focus and measurement around social justice, and by whom? And have you seen growth of diversity factors, race and ethnicity factors specifically?
Yeah, when as we worked on the 2020 Trends report, we were basically taking a snapshot of the policies that investors had as of December 31st, 2019, as 2020 started. So when we think about a lot of the events in 2020, they were happening after that point. So what we found was that, we asked on our survey about board diversity, equal employment opportunity, human rights issues. We didn't see a big change from 2018 to 2020 in terms of the value of assets to which these ESG criteria apply as reported by money managers and institutional investors. However, we did ask a question. We included a new question on our survey about just to kind of get at things that might be changing. And our survey went out in March, so we asked about the pandemic, and the question was, please share your opinions on how U.S. sustainable and ESG investing will evolve by 2025, and particularly in the wake of the COVID-19 pandemic. And we heard from 31 respondents. Nearly half of them said that they expect social factors to gain more prominence. And they predicted that diversity and racial and gender equity will attract more attention, as well as strategies that promote well-being, preventive health, strategies that value employees as assets, and look at developing human capital. And we saw a number of investor initiatives this year to responding to George Floyd's murder, and too many other incidents of Blacks losing their lives, at as a result of police action. So this is definitely becoming more prominent, and I would expect it to be reflected much more in our 2022 survey. And certainly we saw a lot of attention to diversity and inclusion issues in shareholder proposals over the last few years. There's been much more emphasis on getting companies to report on, break down their workforce by gender and race and, I guess, work class, skill level. There's been proposals calling on companies to examine whether they have a gender pay gap, and if so, to close that gap. So I think that's another area to watch is the shareholder proposals that will be filed in the coming annual meeting season.
Great, thank you for that thoughtful answer. One other question we had gotten was, how do you differentiate greenwashing from actual ESG integration and asset management?
That is a good question, and one we wrestle with. We do, and we're, now that we're finding that sustainable investing, as we've long defined it, is representing, 1/3 of professionally managed assets in the United States, it kind of makes sense to take a step back and go, okay, well, do we want to have a more restrictive definition? So, I'm not quite sure how we'll resolve that, but it's something we are, starting to discuss, the Trends research team. I think one thing, we have often focused on is, although it doesn't actually come into the measurement we use for the Trends report, is, investment firms say that they take ESG issues seriously, what are they doing in terms of their proxy voting? And so certainly, we have a number of guides that we've put out for institutions, money managers, financial advisors who are interested in sustainable investing, who are entering the field. And I think US SIF's view has always been, let's welcome them into the field, but encourage them to, move towards best practice. And, one of our best practices is that, if you're talking about ESG as part of your investment analysis, it should also be, if you're holding public equities, it should be reflected in your proxy voting too. And we had a conference a few years ago where there was someone from BlackRock speaking in a plenary session, and I know, she got a lot of questions from our audience about BlackRock's proxy voting record, which was, generally supporting management, even on climate change issues. So that's starting to change. We're seeing a number of these large investment management firms saying, we're going to take proxy voting more seriously. We're going to vote against boards that don't have sufficient diversity. And I think maybe we're starting to see that reflected in, the rising vote levels for shareholder proposals. But, I guess another issue we have is, do investment managers report more specifically on, the ESG criteria they consider? So yeah, we do feel a little, I guess, uneasy about, a broad swath of assets where all we know is that the managers say they consider ESG issues in some way, but without further specifics.
Great. Well, I would like to thank everyone so much for joining us today. We've done our best to answer questions from the audience, but please feel free to follow up with ClearBridge, and we'll be happy to respond to you offline if we didn't get to your question. I'd also like to thank our speakers from the Forum for Sustainable and Responsible Investment, or US SIF, Meg Voorhees, Director of Research, and Brian McGannon, Director of Policy and Programs, for taking the time to be with us today and for sharing this valuable work. I'd also like to mention US SIF has been kind enough to offer a copy of the Trends Report to our listeners and viewers today. You'll receive an email with instructions on how to get access to the report after the session ends. Thank you all. Please stay safe and have a happy holiday season. Please note the following. Past performance is no guarantee of future results. The opinions and views expressed in today's webinar are of the individual speakers as of December 9th, 2020, and are not intended to be a forecast of future events, a guarantee of future results, or investment advice. Any statistics referenced have been obtained from sources believed to be reliable, but the accuracy and completeness of this information cannot be guaranteed. Neither ClearBridge Investments, US SIF, nor its information providers are responsible for any damages or losses arising from any use of this information. Thank you.